Bismillah ar-Rahman ar-Rahim. Ladies and gentlemen, welcome to this short webinar offered by Skills Mastery about Introduction to Petroleum Economics. Let me first introduce myself. My name is Salim Ziglam. I'm a petroleum reservoir engineer by degree. I received my degree from the University of Texas in Austin in 1973. I joined ESSO Libya, which is an American company that was deeply involved in oil and gas exploration and production in Libya during the 70s and 80s. Sorry, 60s and 70s. They left the country in 1982, and the 30 oil company was established. I continue working with 30. So between ESSO and 30, I worked in the field for a few years, then in the Petroleum Engineering Department, then in the Planning and Reservoir Engineering Department. In 1985, I was appointed the manager of Planning and Reservoir Engineering Department. I joined NOC, National Oil Corporation. I was their technical advisor to the joint venture department. And then I moved to Enigas, which is now called Melita Gas. At the time, it's an Italian company, joined a Libyan-Italian company that was in charge of developing a number of discoveries onshore and offshore, mainly gas discoveries. I was also managing the reservoir engineering department. Then I decided to seek early retirement so I can devote more time to consultancy work. I worked with the NOC as a part-time consultant. I conducted a number of petroleum project economic studies for joint venture projects. I also had more time to deliver my courses abroad. So I delivered my courses throughout North Africa. In addition to Libya, I delivered my courses in Egypt and Tunisia. Also in Europe, I delivered my courses in the UK, in Cyprus, and in Turkey. In the Gulf region, I delivered my courses in the United Arab Emirates, Kuwait, and Oman. Also in other Asian countries such as Syria, Pakistan, and Kazakhstan. So you can see that these courses are, they have international flavor, and they have been highly commended by the participants and by their employers. These courses are mainly, reservoir engineering, petroleum engineering, production operation, and of course, petroleum economics courses. What I plan to talk about today is, first of all, I will give some information and introduction about petroleum economics for around 15 minutes. Then I will describe two of the courses that are going to be offered by Skills Mastery. This is also in 15 minutes. The courses are Basic Petroleum Economics. It's a 5-day course. And Petroleum Project Economics and Risk Analysis, which is an intensive 10-day course. And then you will have 10 minutes to ask any questions. Okay, talking about the first subject, which is Petroleum Project Economics. You can see that the economic study is really one of a series of studies that have to be conducted before giving the green light to implement any project. These studies are considered either, kind of quick analysis or detailed studies or quick screening, such as social or community study, marketing study, legal and political, financial, technical. So the last study that has to be conducted is the economic study that will dictate whether the project is economic or not. If it's economic, we can proceed with the implementation of the project. If not, then the project will have to be dropped. Okay, we are still talking about upstream oil projects. This kind of project, they have unique characteristics, very much different from other industrial projects. Why? Because oil projects are considered high risk, especially in the area of oil and gas exploration and development. Finding oil and gas is a risky situation. There is a high degree of uncertainty, especially in predicting future values such as prices, costs, production rates, reserves. Oil projects are considered capital intensive. That means it requires a huge amount of money in order to explore and produce sufficient oil and oil reserves. It requires a long period from the time the project starts until the profit is gained. There is normally limited production period. The contract always put a certain limited time, such as, let's say, 20 or 30 years, which will include exploration, development, production, and so on. Oil project, many people consider them non-technical, don't rely very much on technology, but actually they do. They rely on high tech, especially in the area of reservoir simulation, seismic interpretation, well logging. So they use really the state-of-the-art technology. And finally, these projects are considered high reward and high return. So what is the main objective of implementing any project? Of course, everybody knows, mainly profit. There could be some secondary and tertiary objectives, but the main one is profit. That's why economic evaluation is very vital in evaluating these projects. So why do we run economics? Why do we do economic studies? Of course, to ensure profitability. We want to make sure that the project is going to earn the anticipated profit by the end of the day. Also, to select between alternatives. Sometimes you have a number of projects and you don't know which one is the best from economic point of view. So economics will dictate which one. Like, for example, if you have a field that's on production and you want to increase the production rate, what can you do? Well, we can increase production rate by drilling more wells, by implementing one of the artificial lift methods, by applying secondary or tertiary recovery. So there are many ways to increase production. Okay, which one is the best? The best does not necessarily mean that you will get the highest reserves, but economics will tell you which project should be implemented. Economics is a decision-making tool, and we can do that through decision tree analysis, and we will see how to do that a little bit later. Also, to determine the added value. Some projects do not generate money, like seismic. You don't get any money out of seismic, but you will get data, and we have to be able to determine the value of this data before we decide to run seismic. So if the added value, let's say, more than the cost, then the project could be implemented. If less, then the project should be dropped. And finally, bank loan. If you decide to obtain a loan from a bank to execute a petroleum project, the bank will definitely require or request you to present an economic evaluation study, so the bank can guarantee that they will get their money back. Otherwise, you will get no loan. Okay, moving to project life cycle of phases, different phases. starting from applying for bid license, going through work program, running seismic acquisition and interpretation, seismic processing, wildcat drilling, which means exploration drilling, until a discovery is found. This discovery has to be appraised in order to determine how much reserves, whether we have a commercial discovery or not. And then develop the field by drilling more wells, development wells, breaking surface facilities, pipelines, and making the field capable of producing oil. Then after development and after production, if the flow rate is low, production rate is low, then we can decide to implement one of the artificial lift methods. There are several ones. We can also implement additional recovery, like secondary and tertiary recovery. So all these are considered different phases that the oil field goes through. And when moving from one phase to another, economy has to be conducted. From wildcat to appraising, discovery, to developing, to implementing artificial lift. For each of these cases, it will require economic. If economic prove viable, yes, we can continue. Otherwise, the project should be dropped. So in summary, economic evaluation is a decision-making tool. It will help decide whether we proceed or not. When to do economic study? Of course, you will need to do economic study before starting a project. But in many cases, we find projects are being executed without considering economics, which is really a disaster. But economic has to be conducted before the project is executed. But after we know exactly what we plan to do. So we need some technical definitions to be available before running the economic study. Also, we will need economics when there is deviation from an existing plan. Just an example, if there is a plan to develop a field and it's economic and everything is okay, and then management give directives to change the scope of work. They say, okay, let's connect that field to another one and produce both of them. Since the scope of work changed, then economics will have to be updated or redone. Also, when a previous assumption is no longer valid. If a study was conducted based on, let's say, the current oil price, which is what, $80 a barrel now, it's feasible and we can proceed with developing the field. But if the oil price drops or any of the data changes, the assumed data, previous assumption, then the economic will have to be redone. Okay, moving now to the courses that are going to be offered by Skills Mastery. The first course I'd like to talk about is the Basic Petroleum Economics course. It's an online course that will last 1 week, starting December the 5th. And it will cover really the fundamental and the basics of petroleum economics. My approach in this course is that I'm assuming that whoever is going to attend the course will have no economic background. So I'm starting really from zero, starting from scratch. You don't need to have any background to take this course. And the difficulty builds as we go along. Each day will consist of a number of exercises. And this is very important. It's important to work the exercises to ensure that you understood a topic before we move to the next one. Otherwise, you will lose track of what's going on. So the participant will have to work a number of exercises. These exercises are considered simple exercise and for training purposes only. This is just an example of one of the exercises. You'll be given certain data and you'll have to do a quick calculation to come up with the answer. What are the objectives of this course? First is to understand various economic terms used in the oil and gas industry. So in case you attended the presentation regarding certain economic analysis or economic study, you will understand what the consultant is talking about. You will be able to carry out cash flow analysis and determine the economic indicators, and carry out different economic analysis, not necessarily a complete study, but certain analysis such as sensitivity analysis and decision tree analysis. You'll be able to evaluate and quantify risks and uncertainties. Of course, risk and uncertainty are very important. It should not be neglected or avoided during the study. So we'll be able to assign numbers or values to risk and uncertainty so we can work with. You will be able to make the right investment decision in the presence of risk. And finally, carry out certain sensitivity analysis, which will determine the sensitivity of a number of key economics on the profitability of the project. Who should attend this course? The course should be attended by anybody who wants to obtain basic knowledge about petroleum economics and understand the role of economics in investment decision making. Namely, the people who work in the upstream oil operation, like the geoscientists, such as engineers, petroleum engineers, reservoir engineers, geologists, geophysicists, economists, planners, accountants, and others, all those who have direct or indirect relation with the project execution. I highly recommend decision makers to take this course. Why? Because they make vital decisions. And I want to make sure that they make the right decision. Such as supervisors and managers in key departments like planning, exploration, production, projects, finance, technical departments in the oil and gas companies. Okay, during the course, I will talk about three main parts. The first part is called cash flow analysis. The second part, economic indicators. And the third part is risk and uncertainties. So it's a 5-day course, so each part will last for 1.5 days or so. Talking about the first part, which is the cash flow analysis. Cash flow analysis is really the backbone of any economic evaluation. You cannot study the economics of any project without constructing cash flow calculations. So during this part, you will learn how to make cash flow calculations, profit and tax calculations, which is different from cash flow, but we will need to conduct both of them during this cash flow analysis. This is just a quick, just a picture of simple cash flow calculations. From production and cost data, we can determine the revenue, the royalties annually, and we have to conduct profit calculation in order to calculate the profit and the tax using one of the depreciation methods. And finally, a cash flow tabulation where we will list all the monies that are going to be received in the future and going to be spent in the future. And the difference will be the net cash flow. So the cash flow calculation will give me the net cash flow profile throughout the life of the project. And this will have to be done annually. Next, I'll talk about sunk costs, which is a very important subject. Sunk costs means the costs that have been spent in the past, and we can do nothing about it. We cannot recover it. We cannot get it back. but we can make use of the sunk cost in improving the economics of the projects, and we will see how to do that. What the sunk cost consists of? Number one, seismic acquisition, obtaining seismic data, seismic processing or interpretation, drilling wildcat exploration wells, and also drilling appraisal wells. All these activities cost a lot of money. And all of these have been done before the first year of the cash flow analysis. So they are historical costs, but we can, as I mentioned, we can benefit from these costs by improving the economics of the project, and we'll see how to do that. Inflation is a key factor in economic calculation. We know that the prices are increasing, the costs are increasing, and we have to incorporate that in the cash flow analysis. I will also cover petroleum fiscal regime. Each country, each company, they have their own fiscal regime, or they preferred they are the ones that control what type of contract to sign. There are quite a number of fiscal regimes that are being used worldwide, like concession agreement and contractual. Contractual consists of service agreement, production sharing, buyback, and technical assistance. The service agreement includes pure service agreement and risk service agreement. So I will spend some time talking about concession agreement, production sharing, and service agreement during the course. And for each one, I will give these are the key ones. I will give the advantage and disadvantage of each, and where they are being implemented worldwide. You can see some of the countries, they use concession agreements, others they use production sharing, others they use service, and so on. Depreciation methods will also be covered during the course. There are a number of methods, and we will see how to calculate the depreciation, the annual depreciation. EPSA 4, many people heard about it. It's exploration and production sharing agreement. It's a special case of the petroleum fiscal regime, especially during the production sharing. So this is what's being implemented now in Libya, and we will go through it in the course. And finally, project financing. Sometimes you need to borrow money from a bank or from a financing institute in order to execute the project. And we will learn how to deal with the banks and how we can incorporate this bank accounts in the cash flow calculations. The second part of the course, I will talk about various economic indicators. Sometimes they are called profit indicators because they indicate how profitable the project is. I will go through a number of indicators and finally make some quick comparison between these indicators. What are the indicators? Namely net present value, internal rate of return, payback period, and profit to investment ratio. These are the key indicators used in the oil and gas industry. There are some minor ones which are less significant, but these are the ones that has to be calculated in order to evaluate the profitability of any project. The last part, which I will cover in the course, is part 3, which deals with risk and uncertainties. As I mentioned, the risk and uncertainties are very vital. We cannot just ignore them. Any project that is implemented in the oil and gas industry will contain some certain degree of risk and a certain degree of uncertainty. And we have to include that in our calculations. We have to qualify them, convert them to numbers to work with. Okay, what's the meaning of risk and uncertainty? Uncertainty is really the inability to predict future events. You cannot predict what's going to happen in the future. Nobody can. So this guy, he doesn't know what number he will get. 1, 2, 3, 4, 5, or 6. He doesn't know. And this is what's meant by uncertainty. He's uncertain what's going to happen in the future. But if what's going to happen in the future will cause him to lose money, which means the probability of an undesirable outcome, means there is a possibility that something bad could happen. This is risk. Okay, in the oil and gas industry, we have both risk and uncertainty, and we have to consider both of them. Uncertainty, we don't know what's going to happen to the oil price in the future, to the costs, to the production rate, to the reserves. They, of course, very important, and they will affect the profitability of the project. In the risk, of course, example is drilling an exploration well. Exploration well is very costly. Onshore, maybe a well would cost $10–20 million. Offshore, it may cost even more than $100 million. So to decide to drill a well is a very risky decision. And after drilling the well, maybe the well will end up to be dry. So the risk is very high. So for petroleum engineering, uncertainty and risk should be evaluated. Okay, what are the topics I will cover during the part 3? I will cover expected value concept, decision tree analysis. Since there is a risk and uncertainty, then we have to construct decision tree in order to make certain decision. This is an example of a decision tree. You want to make decisions such as, should I run seismic or not? Should I drill or not? So this tree is built that summarizes the whole story. And there are some branches. And for all of these branches, we have an outcome. We have probability of success and probability of failure for several cases. And we can solve this tree and be able to make the right decision whether to run seismic or not, whether to drill or not. So this is just an example of a simple decision tree analysis. Probability analysis will also be covered. Sensitivity is very important because we have to investigate what could happen to the profitability of the project when any parameter is varied. We will be able to construct a spider diagram and tornado diagram to demonstrate the sensitivity. This is just an example of the spider diagram. It shows what will happen or what could happen to the profitability of the project if any of the variables or if any of the assumed parameters changes or varies in the future. They could vary. Oil price could go up and down. Reserves could go up and down. Operating cost, capital cost, and so on. So it's very important to understand how sensitive the project is to the variation of these data or of these parameters. So a spider diagram like this one should be included in the study. Also, a tornado diagram, also another way of demonstrating what will happen to the economics of the project. Okay, it's on now. Okay, sorry for these interruptions. Let me continue now. I'm still in part 3 that covers risk and uncertainties. Of course, any economic evaluation should include a sensitivity analysis, particularly the spider diagram, which is shown here. This diagram will show what will happen to the profitability of the project if any of the input variable changes in the future, because since they will take place in the future, then there is no way I can be sure. There is always a certain degree of uncertainty. So so this diagram complete the picture. So like, for example, if I deliver a study based on certain parameters and then things change in the future, somebody can come and say, no, it's a bad study because this didn't happen, or the value changed. But actually, this picture will complete this chart will complete the picture, and the study will be complete. Okay, in addition to the spider diagram, there is a tornado diagram, which also demonstrates the sensitivity of the profitability of the project to variation in some parameters. Okay, the next item, I'll talk about probability distribution, such as this, certain input parameters has certain probability distribution, and Monte Carlo is used to take this probability distribution of input variables. Using the iteration, we can get probability distribution of the output, like MPVs or reserves and so on. Okay, what are the steps of doing economic evaluation study according to the course? The first step is to define the assumed parameters, like technical and financial definition. I cannot do a study without concentrating or paying more attention to the accuracy of the data used in the study. Everybody knows that garbage in, garbage out. If the used data is not accurate, is wrong, then the whole study will be useless. So we have to pay a lot of attention to gathering data, technical and financial data, and verifying these data. Then running cash flow analysis is the next step. Determining economic indicators, conducting decision tree analysis if there is a high degree of risk, and also conducting sensitivity analysis, which will the data by plotting spider and tornado diagrams. And finally, a report is issued. Let me stress one thing, that the report here should be as complete as possible, as comprehensive as possible, as clear, and should not have any typing errors or misspelling or something, because the quality of the report will reflect the quality of the study. So if you present a lousy report, it indicates that the whole study is lousy. So spend some time, pay a lot of attention to data gathering and verification and the report. The remaining are more or less mathematics. It's mostly mathematics, but these two require a lot of effort. Okay, this is a flow diagram of steps-by-step economic evaluation. As I mentioned, after collecting data, then cash flow is conducted. Economic indicators are determined. If there is a risk, then we conduct decision tree and continue. If I'm uncertain about some data or some input parameters, then I run sensitivity. This sensitivity could indicate that there is a critical item or critical input that will highly affect the economic of the project. And instead of just finishing the study and issue the report, we have to go back and try to reduce the degree of uncertainty of this particular input, such as as an example is the reserves. Of course, everybody knows that the reserves, the profitability of the project depends on the reserves. if the reserves goes below a certain value, the project could fail. So I want to reduce the degree of uncertainty in the reserves before I complete the study or before I execute the project. So I go back and work on the reserves. By how can I increase my confidence in the reserve figure? By probably running some seismic processing or reprocessing, by drilling some wells, by doing some geologic studies. So I can do something here in order to increase my confidence in the reserves and continue the study. Now, course number 2 is called Petroleum Project Economics and Risk Analysis. This is an expanded version of course number 1. I mentioned course number 1 is more or less, kind of basics and fundamental to give you a general idea about petroleum economics. But this course is more comprehensive and intensive. It starts with it's a 2-week course starting December 19th. It includes basic and also advanced. So the topics that will be covered in course number 1 will also be shown here in course number 2, but with more elaboration and more advanced topics will be covered. Also, an additional part will be included in that course, which is a workshop. It's going to be a real case workshop where each participant will have to build an economic model using spreadsheet, using Excel. Okay, this real case workshop will consist of building a model using Excel and generating a number of important charts. The participant will be introduced to spreadsheet calculation, especially some of the inbuilt Excel that will help with the calculation of cash flow and the economic indicators. Then the whole model will be constructed. The model is going to be a real case oil field development project under different fiscal regimes. So we're going to use a concession agreement and production sharing agreement. So it will be actually 2 different models. Calculation, it's important to calculate the input parameters from raw data. So we'll be giving a set of raw data. And with this raw data, you will have to calculate the input parameters like the production rate using from the decline curve, the decline rate. You could be able to produce the production forecast, the capex and opex, and many parameters using raw data. Once we have these parameters, we can construct cash flow calculation, determine the economic indicators, and finally conduct sensitivity analysis by plotting the spider diagram. So this is this part 4 is going to be included in the second course. Okay, thank you very much. This concludes my presentation. Now the floor is yours. If you have any question, please feel free to ask.